Hello students, welcome to this video lecture. We are dealing with the subject investment management, and today we will study Unit 1 of investment management. Well, Unit 1 will be studying the theoretical concepts related to the various concepts of investment, saving, and the difference between gambling and hedging, and other concepts. First, we'll understand the meaning of investment. An investment is the purchase of goods that are not consumed today but are used in the future to create wealth. In finance, an investment is a monetary asset purchased with the idea that the asset will provide income in the future or appreciate and be sold at a higher price. An activity that commits funds in any financial or physical form in the present with an expectation of receiving additional return in the future. Investment in its broadest sense means the sacrifice of current rupees or amount for the future rupees. Very two different attributes are generally involved, which are time and risk. The sacrifice takes place in the present and is certain. The reward comes later. Students, please understand. So whatever we are saving every month or every year, that has to be invested so that we will be getting returns in the future. So what I'm trying to tell you is, investment is the sacrifice of current rupees for the future reward. Generally, investment means conversion of cash or money into a monetary asset or a claim on future money for a return. In finance, we say investment means the purchase of a financial product or other item of value with an expectation of favorable future returns. In general terms, investment means the use of money with the hope of making more money in the future. And always remember, students, whatever you invest today, over the next few years, the returns what you will get, that has to beat the inflation. And that is very, very important. So the returns what you will be generating from your investment should obviously beat the inflation rate. Now in this slide, we will understand the difference between the investment and the speculation. See, students, a small example I want to give you. Suppose if you are earning every month a salary or a business income of say 15,000, and after removing your expenditure, monthly expenditure, you are saving 5,000 every month. So 5 multiplied by 12, which is equal to 60,000 every year. So every month 5,000 you need to invest in some financial instrument so that you will be getting decent returns in the future. Otherwise, what happens if you are just saving in your bank account, that 5,000 remains 5,000. So what we say, rupee one invested in some financial asset will never be the same. So today we speak about power of compounding. So when we speak about power of compounding, we call it as eighth wonder of the world, right? So now in this particular slide, we'll understand the difference between investment and speculation. Now on what basis we can understand the difference between investment and speculation? So based on meaning, types of contract, length commitment, source of income, risk, then stability of income. Then there are other parameters also we'll be discussing. First we'll take the meaning and try to understand the difference between investment and speculation? Well, please remember students, investment, what you are investing here, whatever you are saving, that you are investing in a financial instrument, or it can be gold, or it can be real estate, right? So the investing of money happens over there in terms of investment, whereas speculation, a message expressing an opinion based on incomplete evidence. So here what you are trying to do, you are trying to speculate. So the probability of gaining some profit or loss will be there. Okay, so remember this, investment is for long term. When we say investment, it is always for long term, and when we speculate, it is for short term. Okay, so the second type, that is the second basis of difference, types of contract. Investor is a creditor of the investment, whereas in case of speculation, speculator is an owner of the speculation. Then length of commitment, as I mentioned to you, the third basis of difference. In the case of investment, the length of commitment is a long term. In the case of speculation, the length of commitment is short term only. Then the fourth basis of difference, source of income. The source of income is earning from the enterprise. That means whatever you are saving. Whereas in case of speculation, the source of income is fluctuated and change as per the market price. Then the fifth basis of difference, that would be quantity of risk, what you will be taking in investment and speculation. Since investment is for long term, so the risk, the quantity of risk what I'll be taking will be low, whereas in case of speculation, the quantity of risk what I'll be taking is high. Then stability of income, that is the last basis of difference. Income is very stable, students, in case of investment. Why? Because it is for long term, and the risk what I'll be taking in investment is low to moderate, and when compared to speculation, it will be low. Okay, whereas in case of speculation, income is uncertain, students, and erratic. Since it is for short term and I'm speculating with the prices, so here what happens, the income is uncertain and erratic. And there are other two bases of difference also when I am telling you the difference of investment and speculation. That is psychological attitude of participants. See, when it comes to investment, since it is your hard-earned saved money, investors' psychological attitude is very cautious and conservative. Whereas in case of speculation, speculator psychological attitude is a daring and careless. That means he is willing to take more risk. That means his expectation is also more. So here he becomes sometimes greedy also. Okay, so we should be understanding that the psychological attitude of participants when it comes to investment, he will be very cautious. An investor will be very cautious and conservative. But whereas speculation, when we tell about speculation, a speculator psychological attitude is daring and careless. Then the last one, what the basis of difference could be, reason for purchase. See, when it comes to investment, it is a scientific analysis of intrinsic worth. Whereas in case of speculation, it is unscientific analysis of intrinsic worth. So these are some of the basis of difference between investment and speculation. But here what you need to understand is investment is always for long term, whereas speculation is for short term, and the risk involved in investment is low to moderate, whereas in case of speculation it will be very high. Now, after understanding the difference between investment and speculation, now we'll understand the basic difference between investment and gambling. So students, you already know regarding investment, but we'll study in depth about gambling, then we will understand the difference between investment and gambling. Well, gambling is the act of playing for stakes in the hope of winning, including the payment of a prize for a chance to win a prize. Gambling is fundamentally different from speculation and investment in the following respects. Which are the following respects? The basis of difference, that is creation of risk, transfer of risk, expected return, measure of risk, and activity. We'll take each point and try to understand the difference in terms of creation of risk. Well, investment. In the case of investment, the investors deal with pre-existing risk. That means they'll be conservative. An investor will be conservative. He'll be cautious. Whereas a gambler, he tries to create risk. So he plays between a probability of gaining money or losing money. So the risk what he'll be taking will be very, very high compared to an investor. Then the second basis of difference would be transfer of risk. When it comes to investment, transferring the risk from investors to insurance companies, whereas in the case of gambling, the transferring or shifting the risk is not possible itself. Then the third basis of difference would be expected return. See, always remember, when you invest and when it is for long term, it has given a positive expected return. That means your return would be positive, and it has proved that if you consistently invest in either in equity or in gold or any good financial asset, it has beaten inflation rate also. That means you can expect a very good return which will beat inflation when it comes to investment. Whereas gambling, the probability of making money or losing money. So always remember, gambling has a negative expected return. Only very few cases we have seen that people have made money in gambling. Otherwise, majority of the cases it will be delivering a negative return. And measure of risk, that is the fourth basis of difference. The risk and uncertainty are measurable in the return on any investment. Whereas in case of gambling, the risk and uncertainty cannot be measured because of high degree of uncertainty. See, in case of gambling, a gambler will be taking a huge amount of risk. So uncertainty is very high. Whereas in case of investment, the risk is low to moderate. Then activity. That is the next basis of difference. Investing is a productive activity that provides benefits to the society, whereas gambling is an unproductive activity that harms the society. And one more you can consider, the sixth one, that is the basis of difference, length of proposals. See, always I told you, investment, when it comes to investment, it is for long term. It's a long term proposal. Greater is the risk and expect long term positive rate of return. Whereas in case of gambling, it implies very short term or short term proposal, high risk and greater uncertainty and expectation of high return. So what we studied was the difference between investment and gambling. So as we already discussed, gambling and investment. A gamble is usually a very short-term investment in a game or chance. Gambling is different from speculation and investment. The time horizon involved in gambling is shorter than speculation and investment. The results are determined by the roll of a dice or the turn of a card in case of gambling. Now, people gamble as a way to entertain themselves. Earning incomes would be the secondary factor. That is very, very important here. The risk in gambling is different from the risk of the investment. Gambling employs artificial risk, whereas commercial risk are present in the investment activity. So what we discussed now, we understood the meaning of investment or why one should invest. Then we understood the difference between investment and speculation. Then we even understood the difference between investment and gambling. So one more slide I have included here to make you all understand the difference between investor and speculator. See, basically you need to understand, students, these are the parameters on which we can differentiate the investor and speculator. So you need to understand time horizon required, risk, return, decision and funds. As I mentioned to you earlier, time, the duration for investor, it is always for long term, whereas speculator, it will be for very short period. Risk, since it is for long term, the investor, he assumes moderate risk, whereas speculator is willing to undertake high risk. Return, in case of investor, he likes to take moderate rate of return associated with limited risk, whereas in case of speculator, he is willing to take high returns for assuming high risk. Then decision considers fundamental factors and evaluates the performance of the company regularly. See, always remember, investment is for long term, so an investor considers fundamental analysis. So before investing, he will study the market thoroughly and then he will invest, since it is for long term. Whereas a speculator considers inside information and market behavior. Since it is for very short term, he will only study the prima facie, that is the upper layer of that. He will not go in depth. Funds, use of his own funds and avoids borrowed funds. This is very important, students. An investor will be using his own funds. He will never use the borrowed funds. Whereas speculator, he will use borrowed funds to supplement his personal resources. So these are the basic difference between investor and speculator. I am once again repeating this particular slide. Okay, now we'll understand the features of good income. The first one will be rate of return. See, always remember, when it comes to investment, since it is for longer time horizon, the rate of return should always beat the inflation and the rate of return should be positive. So rate of return on an investment for a period is defined, how we calculate rate of return, it is annual income plus ending price minus beginning price divided by beginning price. So rate of return when it comes to investment should be positive and it has to beat the inflation. Then the risk. See, when it comes to investment, the amount of risk what an investor will be taking would be always low to moderate. So risk of an investment refers to the variability of its rate of return. The greater the variability or dispersion of the possible outcome, or the broader the range of possible outcome, the greater is the risk. So how do we measure risk? We use the parameter called, or we use the standard deviation to measure the risk. If the standard deviation is too high, then we say the risk associated will be too high. Total risk of a security is equal to unsystematic risk plus systematic risk. Standard deviation is used to measure normally unsystematic risk. Unsystematic risk is specific to the company and is reduced by diversification. Then beta is used to measure systematic risk or non-diversifiable risk that emanates or emerges from uncontrollable forces and is therefore not unique to the stock. Then marketability. An investment is highly marketable or liquid if it can be transacted quickly, the transaction cost is low, the price range between two successive transactions is negligible. High marketability is desirable characteristics and low marketability is an undesirability of any company. Then tax shelter. Some investments provide tax benefits, others do not. Now normally when we say tax benefit, there are three kinds: initial tax benefit, continuing tax benefit, and terminal tax benefit. Now initial tax benefit, it refers to the tax relief enjoyed at the time of making the investment. Continuing tax benefit, the tax shield associated with the periodic returns from the investment. Terminal tax benefit, it refers to relief from taxation when an investment is realized or liquidated. Then convenience. Convenience broadly refers to the ease with which the investment can be made and looked after. The degree of convenience associated with investments varies very widely. At one end of spectrum is the deposit in a savings bank account that can be made readily and that does not require any maintenance effort. At the other end of spectrum is purchase of a property that may involve a lot of procedural and legal hassles at the time of acquisition and a great deal of maintenance effort. Then capital growth. It refers to the appreciation of investment. Capital growth has today become an important character of investment. It is recognizing in connection between the corporation and industry growth and very large capital growth. Investors and their advisors are constantly seeking growth stock in the right industry and bought at the right time. Then stability of income. It refers to constant return from an investment. Another major characteristic feature of the investment is the stability of income. Stability of income must look for different path, just as security of principal. Every investor always, or each investor always considers stability of monetary income and stability of purchasing power income. See, always remember students, when it comes to good investment or features or attributes of good investment, so these are some of the features what we discussed, that is the rate of return, the risk, marketability, tax shelter, convenience, capital growth, stability of income. So now we'll discuss the investment process. The investment process involves how an investor should make decision about the marketable securities to invest in, how extensive the investment should be, and when the investment should be made. The first step would be investment policy. Investment policy involves determining the investor's objectives and the amount of his or her investable wealth. Because there is a positive relationship between risk and return for sensible investment strategies, it is not appropriate for an investor to say that his or her objective is to make a lot of money. Now, what is appropriate is for an investor to state that his or her objective is to attempt to make a lot of money while recognizing that there is some chance that large losses may be incurred. Investment objectives should be stated in terms of both risk and return. The second would be in a security analysis performed. It involves examining several individual securities within the broad categories of financial assets previously identified. One reason to examine securities is to identify those that seem mispriced. Most of these approaches fall into two classification, that is technical analysis and fundamental analysis. Then after that, the third would be construction of a portfolio. A portfolio construction involves identifying specific assets in which to invest and determining how much to invest in each one. The issues of selectivity, timing and diversification need not be addressed by the investor. Diversification need to be addressed by the investor. Then portfolio revision. Portfolio revision is concerned with the periodic repetition of the previous three steps. Now when I say previous three steps, it is investment policy, security analysis performance, then construction of portfolio. Over time, the investor may change his or her investment objectives, which in turn would make the currently held portfolio less than optimal. The investor may create a new portfolio by selling certain securities and by purchasing others. Evaluate performance of portfolio. Now, portfolio performance evaluation involves determining periodically how the portfolio is performing in terms of return earned and the risk experienced by the investor. Thus, appropriate measures of return and risk as well as relevant standard should be always used. So as we discussed in the earlier steps, the various earlier slide, the various steps involved in investment process. So with the help of the flow chart, we can understand it better. So the first one would be investment policy, analysis, valuation, portfolio construction and portfolio evaluation. Now when it comes to investment policy, as I mentioned to you, now investable fund, that is objectives and knowledge. So what is appropriate for an investor to state that his or her objective is to attempt to make a lot of money while recognizing that there is some chance that large losses may be incurred. So investment objectives should be stated in terms of both risk as well as return. Then analysis. See, this should be done properly. We call it as market analysis, industry analysis and company analysis. It involves examining several individual securities within the broad categories of financial assets previously identified. So before investment, we have to thoroughly analyze the market condition. Then we should understand a particular sector. Then we should study the performance of the organization, at least for the for the previous couple of years. Then valuation. That is intrinsic value. Intrinsic value is the actual value of a particular asset. Then the future value. So we have to plan it or have an estimate regarding the future value, because our investment should always beat the inflation rate and our investment should always give us the positive returns. Then portfolio construction. See, here we have to consider diversification, selection and allocation. See, diversification reduces the risk in the portfolio. See what happens, suppose if you are considering various financial instruments in your portfolio like equity or mutual funds, insurance, gold, real estate, commodity market, bank term deposit. See, sometimes what happens is, if equity is not doing good in your portfolio, then you will be getting regular interest from bank term deposit, or gold might give you some good returns, or real estate might give you some good returns. So overall your portfolio will be positive and healthy. See, always remember, whenever you are constructing a portfolio for your investments for a long term basis, your portfolio should consist of all these assets, so that you are diversifying, and if you diversify, the risk can be reduced. Remember that. So based on that, you need to select and allocate your funds into various financial assets. Then portfolio evaluation. So when I say portfolio evaluation, it can be portfolio revision and portfolio appraisal. See, why this portfolio revision is required is, sometimes you allocate the funds into various financial assets, and periodically you should be checking which particular asset or which particular company is doing good, and if it is not doing good, you can remove funds from that and put into something which is doing good. So continuously you need to monitor your portfolio. So that is portfolio revision and appraisal. So these are the various steps involved in investment process. Students, this is very important flowchart. Please remember this. So investment policy, analysis, valuation, then we have portfolio construction and portfolio revision. Then after understanding the investment process, now we'll study the constraints of investment. In pursuing the investment objective, which is specified in terms of return requirement and risk tolerance, one should bear in mind the constraints arising out of or relating to the following factors, that is liquidity, investment horizon, taxes, regulation, and finally unique circumstances. Now liquidity, that is the first constraint of investment. Liquidity refers to the speed with which an asset can be sold without suffering any discount to its fair market price. For example, money market instruments are the most liquid assets, whereas real estate or selling of antiques are the most least liquid. Because real estate, when I want to sell my property, it requires some paperwork for me. Okay. Then the second one would be investment horizon. The investment horizon is the time when the investment or part thereof is planned to be liquidated to meet a specific need. For example, the investment horizon may be 10 years to fund a child's college education, or 30 years to meet the retirement needs. The investment horizon has an important bearing on the choice of assets. The third constraint would be taxes. The post-tax return from investment is a very crucial matter. Tax considerations therefore have an important bearing on investment decisions. So the tax shelter should be carefully reviewed. Then regulations. While individual investors are largely not considered much constrained much by law, institutional investors have to conform to various regulations. For example, mutual funds in India are not allowed to hold more than a certain percentage of equity shares of a public company. Then unique circumstances. Almost every investor faces unique circumstances. For example, an individual may have the responsibility of looking after aging parents, or an endowment fund may be precluded from investment from investing in the securities of companies making certain products like alcoholic or tobacco related products. So these are some of the constraints of investment. Now we'll understand, students, why an individual should invest, or why we should invest. A very important thing is to earn some interest. See what happens, as I mentioned in the earlier slide also, you are saving from your salary or business income after removing your expenditure, say 5,000 rupee every month. So multiplied by 12, which is equal to 60,000, and for 10 years it will be the same amount, whatever you are saving. So what interest you are getting from that? That will be zero. But if you invest that 5,000 rupee every month in some financial asset like equity, mutual funds, derivatives, mutual funds, IPOs, commodities, so that will give you some returns, that will give you some interest which you can use for your future, right? The second would be to beat inflation. See, investment returns should always be positive and it should beat the inflation. So like that you have to construct your portfolio. Longer life expectancy and to save the tax. See, your returns, whatever you will be generating, that should be your tax saving. I mean, you should save the tax from that. In that way, you should construct the portfolio, or in that way, you should add few financial assets in your portfolio. And very important, students, retirement planning, that is future need expectation. You can work up to 60, 65, 70. But when you need to have a proper retirement planning, you need to plan for your children's education, their marriage. So for that, you should see, one thing I want to tell you is start early so that you can gain more. That is possible only when you plan it at an early phase. That is only possible when you invest at an early phase. So future need expectation, you don't know what could be your need in the future. Sudden medical emergency might come, or you need to plan for your children's marriage or education. Okay, then income generation. See, after a certain age you should get some monthly income, right? So you have to plan that generation of income right away when you are 24, 25, because when you start getting your first salary or business income, you should plan for your investment also. So always I will be telling that you start early so that you gain more. So that's why one should invest, or these are some of the importance of investment. Now, investment alternatives, we have financial forms and non-financial form of investment. When I say financial form of investment, broadly into security or marketable financial assets and non-security or non-marketable financial assets. Now, security or marketable financial assets, which involves equity shares, debentures, bonds, whereas non-security or non-marketable financial assets includes term deposit, post office schemes, mutual funds, insurance. Then non-financial form of investment, again we have real estate and precious objects. So non-financial form, we have real estate, as I mentioned, and precious objects. So financial form of investment, security or marketable financial assets, non-security or non-marketable financial assets. Security or marketable financial assets, please remember equity shares, preference shares, debenture, bonds, convertible securities, etc. Whereas non-security or non-marketable financial asset, bank's term deposit, post office schemes, company provident fund, public provident fund, mutual fund, etc. Security or marketable financial assets, as I mentioned, students, equity shares, preference shares, debentures, bond, convertible securities, hybrid securities, derivatives. Non-security or non-marketable financial assets, fixed deposits or banks term deposits, gilt-edged securities, post office schemes or deposits, public provident fund, mutual funds, insurance, other deposits, and money market instruments. Non-financial forms of investment, which includes real estate and precious objects. Now we'll do a quick recap of the things what we discussed. We understood the concept of investment, students. Investment in various types of assets is an interesting activity that attracts people from all walks of life, irrespective of their occupation, economic status, education, and family background. The investor who is having extra cash could invest it in securities or any other assets like gold or real estate, or could simply deposit in his bank account. See, even bank account, that is SB account, even SB interest will be getting on that. The companies that have an extra income may like to invest their money in the extension of the existing or undertake new venture. Investment is the sacrifice of certain present value for the uncertain future reward. Investment is the employment of funds on assets with the aim of earning income or capital appreciation. Attributes of investment, we have already discussed this: risk and time. From the layman view on investment means some monetary commitment, whereas from the economic view on investment, present consumption is sacrificed to get a return in the future. We even discussed about the concepts of investment and speculation and gambling and investment. Speculation means taking up the business risk in the hope of getting short-term gain. Speculation essentially involves buying and selling activities with the expectation of getting profit from the price of fluctuations. Gambling and investment. A gamble is usually a very short-term investment in a game or a chance. Gambling is different from speculation and investment. The time horizon involved in gambling is shorter than speculation and investment. Speculation is short-term oriented. People gamble as a way to entertain themselves. Earning income would be the secondary factor. Risk in gambling is different from the risk of investment. But in investment, there is an analysis of risk and return. Difference between investor and speculator already we have discussed in this earlier slide, but we'll do a quick recap of the things. So basis, time horizon, risk, return, funds. That means on what basis we can understand the difference between investor and speculator. Now when it comes to time horizon, investor is for longer term, whereas speculator is for very short period. Risk, investor assumes moderate risk, whereas speculator, the risk is concerned it will be very high. Return, moderate rate of return associated with limited risk when it comes to investor, whereas the speculator expects high returns for assuming high risk. Funds, investor uses his own funds and he will avoid borrowed funds, whereas speculator uses borrowed funds to supplement his personal resources. Please understand the difference between investor and speculator and investor and gambler. They are very important questions, students. Investment objectives. The main objective or the main investment objectives are increasing the rate of return and reducing the risk. Other objectives like safety, liquidity, and hedge against inflation can be considered as subsidiary objective. Return is equal to capital appreciation and dividend divided by purchase price multiplied by 100. So minimization of risk, liquidity, hedge against inflation. Now what is this hedge against inflation, students? I'm already told you your investment returns should beat the inflation rate. So you are hedging your investment returns against the inflation. And very, very important, students, safety. You invest in a financial asset which is safe because it is ultimately your hard-earned money. Okay? Financial and non-financial forms of investment, this also we have discussed. In financial forms of investment, equity shares, bonds, debenture, IVP, KVP, government securities and money market securities, fixed income. Whereas non-financial forms of investment, the real assets always find a place in the portfolio. They are gold, silver, art, property. These are non-financial investment. Now, features of an investment program. The first one would be safety of principal should be there, adequate liquidity should be there, stability of income, capital growth, also capital appreciation, and tax benefit. So these are the features of an investment program. Investment methods, which I already discussed, that is security form of investment as well as non-security form of investment. Then when we say deposits, it includes the bank deposits, that is in the form of fixed deposits as well as term deposits. Then we have post office deposits and we have NBFC deposits. Then sources of investment information. Now this is very important, students. From where do we get the information related to the investment? So the first would be your financial advisor, or you can use business news channels, that is television. Then you can read an article in the newspaper. So your best source of information is your financial advisor. If you have developed an investment plan based on your financial situation, your capacity for risk, and your investment objectives, your advisor is the best person to help you execute your plan. But to get the right answer, you have to ask the right question, and that requires attention to several economic indicators like GNP or general price level, inflation, GDP, then sensitivity index, Nifty, unemployment, etc. Financial markets are called the backbone of the economy because these provide monetary support and act as a mobilizing agent for the growth of the economy. These are the markets in which money as well as monetary claims are traded in. The functioning and status of these markets are indicators of the growth of the economy. Someone has rightly said that the growth of the financial market is the barometer of the growth of a country's economy. Financial market structure of financial markets broadly classified into two types: money market as well as capital market. And capital market, we again have two types. In detail we'll be studying in the next unit, that is primary market and secondary market. Primary market is also called as IPO, that is initial public offering, and after that when the shares will be listed, that market is called as secondary market, also called as equity market, wherein the investors or traders, they can purchase directly in the secondary market. Money market, it is the market in which liquid funds, cash as well as highly liquid securities are traded in for a very shorter duration or time period. The main participants in this market are banks and financial institutions. This market provides liquidity support to the banking and Reserve Bank of India. And RBI uses this market to access monetary control in the economy. Following are the main instruments or activities in the market: call money market as well as government securities or gilt-edged securities. Call money market, it is a market for banks or financial institutions to lend and borrow on the basis call rates which are floating. Government securities or gilt-edged securities, it is a market for money market instruments of Government of India like treasury bills, commercial papers and CDs. Now primary market, also called as new issue market, also called as initial public offering. It is a market in which companies find an opportunity to have a direct interaction with the investors for the purpose of raising capital by issuing different securities like equity shares, preference shares, debentures, and bonds. For the first time, when the companies want to raise money from the public, they come to this through this process called as IPO, initial public offering. The most common mechanism of raising capital in this market are as follows: rights issue, public issue, private placement, and book building. We will study each one in the next slide, students. Now, public issue. Public issue, where the securities are issued to the members of the general public. It takes the form of public issue. It is the most common method of raising long-term funds from the companies. Now, why do companies go for public issue? It might be many reasons, like infrastructure expansion, or they're expanding their company's operation, or they might have acquired a new company. So there might be plenty of reasons due to which there might be a capital requirement for them. So what they'll do is they'll come with an IPO process through primary market and raise funds from the public, and they will be utilizing that in their business operations, and the returns will be generated in the form of capital appreciation as well as dividend, which will be distributed to all the shareholders. Then rights issue. See, as the name only suggests, where the issue of equity shares of a body corporate is made to the existing shareholders as a preemptive right. Under this method, additional securities are offered for subscription to the existing shareholders. Now, what happens in rights issue? Already the equity shares will be there present in the demat account of a particular shareholder. For him, an option will be given by the companies through rights issue. So it is the right of an equity shareholder to acquire these shares normally at a lower price. So where the issue of equity shares of a body corporate is made to the existing shareholders of a preemptive right. We have the next method, that is private placement. In a private placement, where the shares of a body corporate are sold to a group of small investors, it obviously takes the form of private placement. Then we have book building method, a method of marketing the shares of a company whereby the quantum and price of the securities to be issued will be decided on the basis of bids received from the prospective shareholders by the lead merchant bankers, and this overall method is called as book building method. Now, after understanding the new issue market or primary market or initial public offering, now we'll come to the secondary market. Students, please understand the entire equity market is regulated by Securities and Exchange Board of India, that is SEBI. So it is a market in which the outstanding securities of corporate houses and government are traded in through the intervention of members of the stock exchange. All the transactions entered through the members of the stock exchange become valid and legal only when these are reported to the stock exchange. Stock exchange provide necessary facilities for the trading of securities on the floor of the stock exchange. Once the IPO process gets over, the shares will be listed in the secondary market, and it is open for an investor or a trader to purchase or sell directly in the secondary market. Now we'll understand who are the major players in the secondary market. Like we have foreign institutional investors, or we have portfolio investors. Then corporates can directly participate in the secondary market. General public, sometimes general public is called as retail investors, or they can take the form of high net worth individuals. then banks, insurance companies, mutual funds, portfolio management companies, wealth management companies, then some of the investment companies. So students, these are the major players. Now when I say major players, now these players can invest in secondary market. But one thing you have to remember, that the secondary market, that is the Indian equity market, is regulated by SEBI, Securities and Exchange Board of India. So in India we have more than 40 asset management companies who are the major players in the secondary market. When I say asset management companies, they are the mutual funds. Then we have banks, other financial institutions. We have plenty of portfolio management service companies. Then we have plenty of wealth management companies. Okay, we have high net worth individuals. We have retail investors. We have foreign institutional investors, also called as portfolio investors. Now, instruments of secondary market, we have equity shares, we have preference shares, we have debentures, then we have bonds, and we have non-voting equity shares, etc. But today, in secondary market, we can even invest directly using the exchanges, the mutual funds also. We can directly invest in mutual fund. We can directly redeem the mutual fund using exchanges, because even mutual fund units are listed in the secondary market. Stock exchanges, when we come to stock in India, we have two popular stock exchanges, that is National Stock Exchange and Bombay Stock Exchange. Stock exchange is a regulated marketplace in which listed securities are bought. Please understand the word listed securities over there, are bought and sold through the intervention of members, brokers of stock exchange, by following an open system of two-way quotation. The settlement of trade is done according to the bylaws of the stock exchange. So stock exchange is a place wherein the securities, the shares, can be bought or sold with the help of brokers. Now, functioning of stock exchanges, when we say buying and selling, how it happens, trading mechanism at National Stock Exchange and Bombay Stock Exchange. Students, NSE consists of top 50 companies, and BSE consists of top 30 companies. Now, when I say top 30 and top 50, it is in terms of market capitalization. So market mechanism is the system of buying and selling the securities or derivatives in the stock exchange. An efficient market mechanism always provides for the smooth functioning of the stock exchanges and helps in the speedy settlement of the stock exchange and helps in speedy settlement of trades to the satisfaction of all the parties involved in the activity. The stock exchange has a few components like investors. As I mentioned, when I say investors, it can be long-term investors. Then we have traders who do intraday, buy today, sell today, or buy today, sell tomorrow. Then we have brokers. Then we have stock exchange officials. Then we have clearing houses. So these are the some of the components of exchanges. To buy or sell the securities on the stock exchange, the following sequential activities takes place. First, an investor or a trader will place an order. Then execution of order will take place. Now, how the execution will take place? Suppose the current market price of XYZ company is trading at 30 rupee per share, and if he puts the market order, that means if he put an order at 30 rupee, and if it is matching with the current market price, automatically execution takes place. Okay, suppose you want to purchase it at 29.5, then it will be waiting when the current market price reaches 29.5. When it matches with your order, then only we say the order is executed. Then after that the reporting of trade happens, then confirmation message will come, then exchange between the client and the broker, then clearing function, and exchange between broker and the client. Now what exchanges between client and the broker? First he has to pay the amount for that. First he has to pay the check to the broker. So that much worth shares he can purchase it with the help of broker. So brokers are called as, stockbrokers are called as intermediaries. Okay. Then when he does that, automatically the shares will be transferred to the client's demat account. Now as I mentioned in the earlier slide, placing an order. Once a decision to buy or sell has been done by the client, he will place an order to his broker. For example, it can be a market order. That means the current market price, whatever it is reflecting over there on the terminal. If you want to purchase for that particular price, you say market order or limit order. That means suppose if you want to purchase, then you will put a price lesser than the current market price. Suppose if you want to sell, then you will obviously put a price higher than the current market price. Then execution of order. The broker executes the order on the floor of the stock exchange as per the order specification of the client. On the floor in the sense on the terminal. Then confirmation of transaction. After the execution and reporting, it is necessary to give a confirmation to the client by issuing a contract note. Now, nowadays what happens is, on a real-time basis you will be getting a confirmation on a real-time basis. So it will be the contract notes will be sent to your mail inbox, or you will be getting a message directly from the broking firm that these many shares have been purchased. Then exchange between the client and the broker. The broker takes money or shares from his clients before the pay-in or the payout day. Then the role of clearing function. Every stock exchange has a clearing house which facilitates the settlement of net position of brokers as follows. On pay-in day, purchasing broker is to pay the money in its bank account maintained with the bank of the clearing house, and the selling broker is to give the delivery of securities to the clearing house. On payout day, the purchasing broker receives the delivery of securities from clearing house, and the selling broker receives money in his bank maintained with the bank of clearing house. So this happens on a fast basis nowadays, on a real-time basis. Exchange between broker and the client. The broker delivers the securities to those clients for whom he has made the purchase and makes the payment to the client for whom the securities were sold. Suppose if I am selling the securities from the demat account, for me the amount will be transferred to my bank account, and if I have purchased the shares through the broker, those shares will be transferred to my demat account. See here, I have demat account means what? Your shares will be held in the electronic form in your respective demat account, and every demat account will be having a DP ID, that is depository participant ID. Same like how you have a bank account, you will go to a bank and deposit amount mentioning the account number. In the same way, every individual who has got an account with the broking firm will be identified with the help of a DP ID. So it will be unique for an individual. As I mentioned students earlier, SEBI is also called as the watchdog. The Securities and Exchange Board of India is the regulatory authority established under Section 3 of SEBI Act 1992. The major objective or the main objective of SEBI is to protect the interest of the investors in securities and to promote the development of and to regulate the securities market and for matters connected therewith and incidental thereto. So SEBI is called as the watchdog of the equity market. SEBI is the regulatory body of our Indian equity market. Indices of Indian stock exchanges. Now what is an index? We'll understand what is an index first. A stock index or stock market index is a measurement of a section of the stock market. From among the stocks listed on the exchange, some similar stocks are selected and grouped together to form an index. For example, we have BSE, that is BSE Sensex, as an index, NSE, that is Nifty 50, as an index. Now, after understanding the meaning of index, we'll now understand how are indices formed. An index consists of a similar stocks. This could be on the basis of industry, company size, market capitalization, or other parameter. Once the stocks are selected, the index value is calculated. This could be a simple average of the prices of the components. In India, the free float market capitalization is commonly used instead of prices to calculate the value of an index. The two most common methods of forming indices are market capitalization weighted index and price weighted index. We will understand these two in detail in the next slide. Market capitalization weighted index. The stock market is broadly divided on the basis of market capitalization as among large cap, mid cap and small cap. Market capitalization is the total market value of a company's stock. It is calculated by the multiplication of the number of outstanding shares company offered with the current market price of the share. It thus takes into consideration both the size and the price of the stock. In an index using market cap weighting, stocks are given weight on the basis of their market capitalization in comparison with the total market capitalization of the index. For example, if stock A has a market capitalization of rupees 10,000, while the index has a total market capitalization of 1 lakh, then its weight will be 10%. How, students? Stock A has a market capitalization of 10,000 while the index has a market cap of 1 lakh. That means the total weight of A will be 10%. Similarly, another stock with a market cap of 50,000 will have a weight of 50%. In continuing with the earlier slide, the market capitalization weightage method gives more importance to companies with the higher market caps. In India, most indices use free float market capitalization. In this method, instead of using the total shares listed by a company to calculate market capitalization, only the amount of shares publicly available for trading are used. As a result, free float market capitalization is a smaller figure than the market capitalization. Price weighted index. In this method, an index value is calculated on the basis of the company's stock price and not market capitalization. Stocks with the higher price have greater weightings in the index than stocks with the lower prices. The Dow Jones industrial average. Just an example I'm telling you. In the US and Nikkei 225 in Japan are examples of price weighted indices. These are just an example. So what happens in price weighted index? An index value is calculated on the basis of company stock price and not on the market capitalization. Now, what are the different types of indices in India? Most of the trading in the Indian stock market takes place on its very popular stock exchanges, that is the Bombay Stock Exchange and the National Stock Exchange of India. The BSE has been in existence in 1875. The NSE, on the other hand, was founded in 1992 and started trading in 1994. However, both exchanges follow the same trading mechanism, trading hours, settlement process, etc. The BSE has about 4,700 plus listed firms. Now it has crossed more than 6,000, whereas the rival NSE has about more than 3,000 or 3,000. Out of all the listed firms on the BSE, only about 500 firms constitute more than 90% of its market capitalization. Following are the different indices in India. There are basically four categories: broad market indices, sectoral indices, thematic indices, and strategy indices. We'll understand each one of them in detail, then with example. First, we'll understand broad market indices. These indices are broad market indices consisting of the large liquid stocks listed on the exchange. They serve as a benchmark for measuring the performance of the stocks or portfolios such as mutual fund investments. BSE consists of top 30 companies in terms of market capitalization. Okay, Sensex, the name only tells sensitivity index. The BSE Sensex, that is Standard and Poor's Bombay Stock Exchange Sensitive Index, also called the BSE 30 or simply the Sensex. I'll repeat once again: sensitivity index is a free float market weighted stock market index of 30 well established and financially sound companies listed on BSE. The 30 component companies, which are some of the largest and the most actively traded stocks, are the representative of various industrial of the Indian economy. Sensex is the stock market index indicator for the BSE and was first published in 1986. How is Sensex calculated? The calculation of Sensex is done by a free float method that came into existence from 1st September 2003. The level of Sensex is a direct indication of the performance of 30 stocks in the market. The free float method takes into account the proportion of the shares that can be readily traded in the market. This does not include the ones held by various shareholders and promoters or other locked-in shares not available in the market. First, the market capitalization is taken into account. This is done by multiplying all the shares issued by the company with the price of its stock. Then BSE determines a free float factor, that is a multiple of the market capitalization of the company. This helps in determining the free float market capitalization based on the details submitted by the company. Then ratio and proportion are used based on the base index of 100. This helps to determine the Sensex. Now other indices are like S&P BSE Consumer Discretionary Goods and Services, S&P BSE Basic Materials, S&P BSE Large Cap, S&P BSE All Cap. Then we have Mid Cap and Small Cap. In the National Stock Exchange, in continuation with the broad market indices, the Nifty 50 index is the National Stock Exchange of India's benchmark stock market index for Indian equity market. Nifty is owned and managed by Indian Exchange Service and Products. Nifty 50 covers 13 sectors of the Indian economy and offers investment managers exposure to the Indian market in one portfolio. Nifty is the market indicator of NSE. It ideally is a collection of 50 stocks, but presently, as 51 listed in it. It is also referred to as Nifty 50 and CNX Nifty by some of its owned. See, normally Nifty consists of top 50 companies in terms of market capitalization. Again, I am repeating, how do you calculate market capitalization? It is number of shares present in the secondary market multiplied by the current market price. It gives the market capitalization. How we calculate Nifty? Nifty is also calculated through the free float market capitalization weighted method. Just like Sensex, Nifty also follows a mathematical formula based to know that the market capitalization. It multiplies the equity capital with the price to derive the market capitalization. To determine the free float market capitalization, equity capital is multiplied by a price which is further multiplied with the IWF, which is the factor for determining the number of shares available for trading freely in the market. The index is determined on a daily basis by taking into consideration the current market value divided by the base market capital and then multiplied by the base index value of 1000. So other indices, just a few examples: Nifty 50 index, Nifty next 50 index, Nifty 100 index, Nifty 200 index, Nifty 500 index. Then we have Nifty mid cap 150 index, Nifty mid cap 50 index, Nifty full mid cap 100 index, Nifty free float mid cap 100 index, Nifty small cap 250 index, Nifty small cap 50 index, Nifty full small cap 100 index, Nifty free float small cap 100 index, Nifty large mid cap 250 index, then Nifty mid small cap 400 index. Sectoral indices. The market sector indices summarizes the performance of stocks grouped by specific market sectors. This allows investors to benchmark the performance of a particular stock market sector or industry. In NSE, sectoral indices in NSE are Nifty, this is sector, like various sectors, it forms an index. Like we have Nifty Auto Index, Nifty Bank Index, Nifty Financial Services Index, Nifty FMCG Index, Nifty IT Index, Nifty Media Index, Nifty Metal Index, Nifty Pharma Index, Nifty Private Bank Index, Nifty PSU Bank Index, and Nifty Realty Index. Then sectoral indices again we have in BSE, S&P BSE Information Technology, S&P BSE Consumer Durables, S&P BSE Fast Moving Consumer Goods, S&P BSE Power, S&P BSE India Infrastructure Index, S&P BSE Oil and Gas, then Auto, Public Sector Units, Healthcare, S&P BSE Capital Goods, S&P BSE BankX, S&P BSE Metal, then S&P BSE Realty. Then we have thematic indices. Our thematic indexes or indices reflect the performance of various broad investment themes. Thematic investing seeks to identify specific social, economic, industrial, environmental or demographic trends and their long-term secular, cyclical and structural influences on the world's economies and markets. Thematic indices, some of them in NSE and BSE are like Nifty Commodities Index, Nifty CPS Index, Nifty Corporate Group Indices, Energy Index, India Consumption Index, Infrastructure Index, MNC Index, PSE Index, Nifty Services Sector Index, 100 Liquid 15 Index, then Mid Cap Liquid 15 Index. In BSE we have S&P BSE Greenex, then we have S&P BSE Carbonex. So these are some of the thematic indices which are present. Then we have strategy indices. Strategy indices are designed on the basis of quantitative models or investment strategies to provide a single value for the aggregate performance of a number of companies. Strategy indices includes Nifty multi-factor indices, Nifty 50 equal weight index, Nifty 100 equal weight index, Nifty 100 low volatility 30 index, Nifty alpha 50 index, 50 arbitrage index, 50 future index, 50 USD index, dividend opportunity 50 index, then low volatility 50 index, 50 dividend point index, quality 30 index, Nifty 50 value 20 index, PR1x, PR2x leverage index. So these are some of the strategy indices present. Strategy indices in BSE, which includes S&P BSE IPO, S&P BSE SME IPO, S&P BSE Dolex 30, S&P BSE Dolex 100 and S&P BSE Dolex 200. Yeah, students, thank you so much for watching this video. In Unit 1, which is a theoretical unit, we have understood the importance of investment, the difference between investment, speculation, gambling, objectives of investment. Then we even understood the investment process. Then we understood the importance of risk and return. Then we even know about, we understood about the various financial instruments available in the market, the meaning and definition of financial instruments, then types of financial instruments. Then we even studied about the capital market instruments like equity shares, preference shares, debentures. Then we understood the importance of SEBI, and finally we understood the various indices. So thank you once again for watching this video.